Good afternoon, everyone. Thank you very much for joining us for another session of RM Smart Investing. Today's presentation, it will be uh, looking at opportunities, but more so on the risk with the investments in commodities, and not only commodities themselves, uh, but also investing in the commodities, what kind of obstacles and challenges we have, and how we can take advantage of these challenges to become more profitable trader or investor. As you know, in the past year or so, the cycles have changed. There's so much more talk of commodities. We've had classes on the commodities in the past 16, 18 months. There are some classes you can refer to. And we've talked about the fundamentals and the foundations of understanding the commodities. So today, again, I'm going to emphasize more on the risks of them and how we can handle them. And now, especially with having more alternative investments, we talk about the emissions, we talk about clean energy, and of course, the cryptocurrencies, the Bitcoin, they actually, we don't have any definition or defining terminology for, let's say, cryptocurrencies. Are they currencies? Are they commodities? What are they? So I thought this might be a timely presentation. So again, the whole goal is understanding the risks in the commodities investing. So what we're going to talk about, we're going to look at the more common risks that involve with the commodities, but as I mentioned, also as a trader, what risk we're looking at. So people with market risk, geopolitical risk, regulatory and compliance risk, the weather and the climate, the liquidity risk, the volatility risk, speculative trading, environmental, counterparty and credit, lack of knowledge risk, concentrated portfolio risk, operation and IT, as well as now this is the newest one, pandemic. So hopefully this will happen every 100 years or not sooner, but since we are in it, I thought we will discuss that. So before I go into that, I think this is important to understand this one terminology, which is, if you're not familiar, is the price elasticity. And what the price elasticity means is how they can affect the demand and the supply, how they supply the prices. If something is, the elasticity means if the prices can be raised incrementally without seeing a fall off in consumer demand, then that price is inelastic. What that means is the price can go up, and if the consumer is indifferent toward that and willing to pay for it, then that becomes the important thing, especially when it comes to the commodities. Of course, when we look at the substitution, if the consumer has a substitute to go in, then the price becomes elastic. So if there is or more of something, and sometimes if it's inelastic, the price doesn't go down. In our situation, I'm looking at, for instance, let's say it was lumber. Let's talk about beef. Now, if somebody is eating beef or lean hogs or even oats, if there is the demand, and with that, because of the supply problems, whatever it is, if the price is going up and consumer is okay with that, then this is the price elasticity. So I think it's very important to understand it in the commodities arena. All right, so let's start with our first risk. Again, it's going to be hopefully short but sweet, and there are quite a few of them. So the biggest one in every asset class that we talk about is the market risk. And in this situation, how it affects, let's say, the commodity prices, actually even the supply and the demand side of things. So the market risk are with the interest rates that obviously it's been a big talk with all the central banks around the world, how the interest rates affect different commodities. For instance, we know in gold being a non-interest bearing asset class, if interest rates go up, it's negative for gold, for instance. Or when we talk about, as of this moment, US dollar still is the currency of choice. And a lot of commodities are priced at dollar. When we think about crude oil, which, as you know, it has come up quite a bit, now that's petrodollar. So all the exporting and importing most of the time is done in dollar. We don't know, maybe 10, 20 years from now, things might change. But as of this moment, the direction of the dollar is important. So the higher the dollar, it makes depresses the price of commodity. The lower the dollar, is a higher price for commodity. That means you have to spend more dollar to buy that commodity. So there's an inverse, majority of time, relationship. Sometimes they go together. It could be based on risk. For instance, if there is a the risk is on, the markets are worried about geopolitical events or something that it can affect the market, usually money could go, for instance, to gold as well as the dollar as a risk off, in a sense, risk off asset classes. So you could see both of them go up, and or even Japanese yen could go up, while dollar and gold going up. So the GDPs also can make a difference. Obviously, if there's economic expansion, it's good for the base metals, base materials, good for the demand. That means, and we'll not be talking globally, the GDP, if it's up, it's helping the middle class, for instance, to grow. Middle class likes to live a better life than the lower class in that sense. So demand for high protein, for instance, food and grains, for instance, they are in demand. So that affects. So GDP can help with the expansion of the growth, or if there's a recessionary, if the GDP is low, economic slowdown, then the demand will go down. Non-farm payrolls, similar to GDP, for instance, they are the employment. The healthier the employment, the more demand and the more affordability. So that's also important. And inflation, which has been talked about now, it affects also the prices of the commodities. And again, when we talk about risk, we are not just talking about the risk of things going down, there's a risk for the consumer. So in this situation, if the higher inflation, it affects food, the crude oil, we talk about precious metals and gold, and subsequently it affects the final product. So that's in a nutshell, and there are more, but I just thought I would give you the more prevalent and important factors. They need to come to the geopolitical risk. When we talk about geopolitical risk, it's not just a threat of war or conflicts alone. It's not about just, let's say, North Korea wants to send, or nuclear testing something. It goes beyond that. There's a lot of interactions between the countries, but also it could be the licensing agreements. One country doesn't want to give, the rights, and let's say there's mining rights, for instance, the tax structure, the labor strikes, which happens quite often, especially in the mining, such as gold or copper or platinum. So these minings go on strikes. The nationalization of these, as far as could be crude oil in the oil industry, it could be nationalization of mining. For instance, we've had, let's say, some more recent examples are, let's say, in Brazil. Brazil comes and wants to nationalize Petrobras, the largest oil company. In Venezuela, which nationalized all the even foreign companies that they have, refineries, and they have, the rights there. Or like say Bolivia or Peru, they decide to do their mining. So those are all become geopolitical. The other thing we think about geopolitical, we think about Middle East, the conflicts, which has been going on for many decades. Now, how does that affect crude oil in this situation? The movement from, let's say, Suez Canal, or we talk about Persian Gulf and the Arabian Sea, the Straits of Hormuz. How does that affect all these conflicts, if there is things happening there, obviously the supply goes down, and if the demand is constant, then the price goes up. Russia decides again, it could be the privatization or having a conflict with Turkey or Ukraine, or we look at the Central Asian economies and countries who have pipelines, for instance, natural gas going to Ukraine or Europe, and Russia wants to control that. So these are all geopolitical risks. And I just talked about Latin America, China, who plays a big role, and they can dictate what they, the rights will be, what they want to be, the demands. So that's all. You have to be considerate of these. So if you want to invest in commodities, just be aware of these factors who can affect, related commodities, especially when you're talking about underground, in many ways, commodities, and talk about fossil, or we talk about mining, for instance. Regulatory risk, which affects a lot of different asset classes, but also is prevalent again, and it's also important in the commodities, especially if you're investing in them. So you want to make sure there's the governance, really, this corporate governance, and basically how they control. So you've heard of the Security Exchange Commission. People think of, for instance, the stocks, they're protected. There's a FINRA, but they also decide, as far as the commodity investings, as far as the brokers. So that's important. NFAs, the National Futures Associations, and the CFTC, Commodities Futures Trading Commissions. So they have to make sure there's the clearinghouses, the trading is done in a manner that is beneficial to the investor, to the trader. They are protected, but we still have seen many firms that go out of business, and that's one thing. Again, we're talking about alternative investments, for instance. That's important to know. Even Fed, the central banks, for instance, central banks, one of their responsibilities, as we've discussed in the past, is the margin requirements. They can come and require higher margins, for instance. So that's part of their responsibility. So the regulatory risk, which is really protecting the investors and traders, is important. This, eventually, I think I'm going to have a class just on its own, because I think it's very important in many ways. But briefly, I will mention it because the things that it can help you understand, again, that the pricing and the effects mainly on the supply of things, and why the weather is such an important thing in so many arrays of commodities. So it's not just underground, it's not just a fossil, but also above the ground, and also on the trees, for instance, and the grains. So a simple example, for instance, hurricanes. Hurricanes happen. One of the biggest things you can think of is the oil refineries, the natural gas, the damages are done, and how long does it take to fix them? So the effects, for instance, especially the energy sector, the typhoons, they can do the same thing. But also, give you one example, for instance, a couple months ago, we had typhoons, let's say in Vietnam, that being one of the biggest exporters of coffee producers, especially Robusta. So that affects the hot weather. Then you have the heat waves. How does that affect for the plantations of the, let's say, in the grains, soybeans, if you have the heat or we have a cold, let's say in Brazil, for instance, we had, and then how does happen with the harvesting, but also actually after the plantations while it's in the ground, when it comes to, let's say it's June and July in Northern Hemisphere, in South America, for instance, Brazil or Argentina, as cold, but how cold can it get? The freeze, if you invest in oranges, for instance, with the orange juice, how does that affect it? How about dry weather, the drought? What happens to the wheat crops, for instance, or corn crops? How about if it's really wet? What happens to barley? What happens to production of, you need a good quality for, let's say in Europe, for the beer and other things. So how does the flooding affect? So now it affects the supply. So all of these play big roles. On top of that, if with the climate changing, how does it affect the, we talk about the streams, we talk about El Nino and La Nina, and the effects of those currents on cocoa production, on coffee beans. How does that affect? How about the sugar? And then again, we talked about, let's say cotton needs a dry climate, and when there's too much rain, what happens? So all of these could be very risky. So if you're familiar with it, then you're not, don't get blindsided with, let's say, a big price drop, for instance, in the price of could be soybean, or we have this big price increase in oat. What happens? So, or cotton, for instance. All of these are important. So the weather is important. As I mentioned, maybe we'll just have independent class if there's enough interest. How about liquidity risk? Liquidity risk, especially in investments. I mean, some commodities such as coal, even lumber, sometimes lumber and emission-related ethanol, sometimes they're not as liquid. So basically, when we talk about liquidity is, all right, it's great. I have this great investments. I did very well, but when the time comes to sell, do I get a good price for it? Is there any buyers, for instance, for this? And that's the bid ask comes into the picture with the liquidity. So that's important. Volatility risk. Now, one of the special things about commodities are they're pretty volatile. So you really have to control your risk. And when you get involved with commodities, whether you play the futures, whether you play exchange traded funds, whether you even play stock related commodity or commodity related stocks investments, you want to make sure to know that there's a high fluctuations in the market prices. A lot of times it happens, let's say, especially like say in grains, we have limits up, limits down, things really move and you have to be prepared for that. And once the momentum starts, sometimes it just continues, and you gotta really be protective. Speculative trading risk. Now, what that means is now about 20-25% of the trading is done by the speculators. And what speculators do, they do not do fundamental analysis. They are not hedgers. They mainly, their job is to take advantage of the price movements. Now, because of their presence, they provide liquidity, because without them, really, we would have had the commercials and the hedgers who would be on the other side. So basically, they provide liquidity. So it talked about the bid and ask prices come narrower, there's enough activity to produce even more. But the problem is, because their objective is different than, let's say, the commercials and hedgers, it causes adverse and quick movements in the markets. And we just talked about limit bounds and limits up. So we have to be watchful of what the speculators are doing. And the next one is environmental risk. Environmental risk could be, especially now with the, from the political point of view, what is happening affecting the refineries, for instance. Are we staying with the fuel energy, or fossil energy, or are we going to move to solar or other types of energy producing alternatives? How about mining, effects of the mining in the environment, and oil spills, and the effect of clean energy, and as I mentioned, closing down other things. So there's that environmental risk, which each country is really responsible for that, and that also becomes a risk, knowing that. The other part is mostly on the, if you do, for instance, forward contracts or you do swaps, is the integrity of the parties. You have a counterparty. Also, there's a credit risk. If there is a lending institution, how assured they're going to receive the money back, or the counterparty, how assured you are that they are going to meet the obligations. So that's the counterparty credit risk. I want to put this in because I think it's very important, especially I've mentioned many times, there's just so much information out there that sometimes we feel that, or we think that just by listening to an information, that makes us knowledgeable about that subject. So I have an old saying that little knowledge is more dangerous than no knowledge. You have to be very careful, especially when it comes to the commodity investing. You want to have a good foundation of that. If it's just based on rumor, as we talked about just briefly about volatility risk, what will happen is it actually will affect you on these whipsaws. And what happens is you can easily lose a lot of your investments. So make sure you have a good handle of things. Make sure you know what kind of risk management tool you're using and what kind of a commodity you're involved with. So that's what I call lack of knowledge risk. The other thing is sometimes you get really excited about some investments. I put down concentrated portfolio risk. Sometimes we don't have that diversification in there. We think that, just a simple example, let's say everybody talks about cryptocurrencies right now. And all of a sudden, whatever investment we have, we say, oh, this is it's a definite win. It's going to make a lot of money. So why do I want to put my money in like a dividend paying long-term investment? I've heard so and so, became overnight millionaire, or there's like they have multiplied their portfolio 100 times. So all of a sudden we come up and put a concentrated portfolio, in a sense that we put our investments in a very few asset classes. So in commodities, you got to make sure you want to have that low correlation. Commodities should be a part of your portfolio, small part. The beauty of commodities is has a very correlations to other asset classes. So it is important to make sure your portfolio is diversified. The other part is talk about is the operation and IT risk, and it is very important as with the improvement of technology and systemizing everything with the robotics and with the algorithms, and our really dependency on networks and internet and the satellites. It's a lot easier now with the cybersecurity and hacking affect the whole, not only just your portfolios, but the integrity of the system relations, how the things are being, constantly, when you think about how some of the largest corporations have been hacked, so you have to be careful with that. And we talked about even data gathering and the transformation of informations. And that's why once in a while you've seen these, we call them flash crashes. We've had them, and sometimes people cannot even describe that. So you have to be aware of that, especially always have a backup plan. The last but not least, who would have thought that I would even talk about this a couple of years ago? But here we are. As I mentioned, hopefully it's not going to be, we will discuss this ever again in decades to come, but it is here with us. It's the pandemic risk, which everyone is going through. It didn't start as a financial risk. It was something that just came, and as you can see, it affected the whole globe. So it affected the supply chains. It has affected the demand. Now it has also affected the labor. And so with the shortage of with the increase of demand, and then the reduction of the demand, and then increase of the demand, and not having, so you can see how the commodities have been affected. Basically, as a matter of fact, this has affected, we talked about the weather, this is also related to that. you can see how the food prices have gone up. And some of the things I mentioned, we talk about grains, but think about milk, cheese. They are byproducts of some of the commodities. Could be cattle, and we talk about grains and the food related. So these are important. So with that in mind, I hope it was short and sweet. I want to just give you a little overview of the things you want to look at, feel comfortable of understanding the risks. So next time when you're thinking of investing or trading, just know, the things the factors that you should look at. So with that in mind, I think we can open up for the Q&A, and Sean, we can stop the recording.